Hello everyone and welcome to another options trading educational video here from OptionsPath. Today we're going to give a quick introduction to one of our favorite options trading income strategies, the Iron Condor. Now the Iron Condor may seem like a fancy name for an options trading technique, but it's really a very simple strategy once you learn its components. The Iron Condor is very simply a combination of two credit spreads, a bear call spread and a bull put spread. Now, if you're not familiar with these two strategies, we do have another video where we explain it in a bit of detail. The link to that video is below in the description box. You could also go to our website at OptionsPath.com to request a free ebook that explains credit spreads even more. So back to the Iron Condor. The name for the strategy comes from its profit and loss or risk graph, which I'll show a little bit later. It looks a bit like a bird or a condor if you use your imagination. So what exactly is the goal of the Iron Condor? Like any single credit spread, the objective of the Iron Condor is for the price of the underlying to stay away from your short strikes. If that happens, you could keep the full premium that you receive immediately when you put on the trade. But let's go back a bit. Just as a refresher, let's talk a little bit about credit spreads. A credit spread is an option strategy that involves a purchase of one option and a sale of another option of the same type, underlying stock, and expiration date, but different strike prices. Credit spread sellers receive a net premium credit for entering the position, with the goal of having both options expire worthless to keep the net premium. A credit spread can be either a call spread, otherwise known as a bear call spread, or a put spread, otherwise known as a bull put spread. When you have both a bear call spread and a bull put spread on, you receive both net premiums combined, which equals an Iron Condor. Now let's show a few options risk graphs or P&L graphs to illustrate further. This is the P&L graph for the bear call spread. So as we can see, we have the short call strike price here and the long call strike price right here. Now, if the price of the underlying stays below the short call strike price, then here, as we can see, we could get max profit by the end of the trade. Now, if it goes above the short call strike price and then above the long call strike price, that's where we could get max loss at the end of the trade. And then here's the bull put spread P&L graph. So as we can see here, we have the short put strike price right here, and then we have the long put strike price right here. Now, if the price of the underlying stays above the short put strike price, that's where we could get max premium profit, as we can see here. Now, if the price of the underlying goes below the short put strike price and then below the long put strike price, that's where we could get max loss, as we can see. Finally, let's combine the two, the bear call spread and the bull put spread, into the Iron Condor. And this is the P&L graph for the Iron Condor. Now, as we can see here, we have the bear call spread up here, and then we have the bull put spread down here. Now, if price stays between the short call strike price and the short put strike price, we can get the combined net premiums from both the bear call spread as well as the bull put spread. And that's our max profit, as we can see here. Now, if the price of the underlying goes above the short call strike or below the short put strike, that's where we can make potential losses on the Iron Condor trade. So essentially, you can receive around double the premium income from an Iron Condor than you can from a single credit spread. And you're basically placing the two credit spread sides well away from the current price, or what's called out of the money. As mentioned earlier, if the price of the underlying stays in between your two credit spreads during the duration of the trade, you could receive full premium. Now, a couple of things to keep in mind as you think about trading Iron Condors. Number one, although we'll sometimes trade these on individual stocks, we generally prefer to trade them on broad market indexes like the SPX or in ETFs, which are baskets of equities. We do this to try and diversify some risk, as individual stocks can move violently on any company or earnings news, whereas indexes and ETFs generally move less violently, as they're made up of multiple stocks or financial instruments. Now, the second thing you should keep in mind is that when putting on an Iron Condor, you don't need to put on both credit spreads, the bear call spread and bull put spread, at the same exact time. In fact, we rarely do this. In order to create as wide an Iron Condor as possible, which usually means it has a higher probability of success, we will generally open bear call spreads when the market is going up and bull put spreads when the market is going down. Again, this helps you create as wide an iron condor as possible. The third thing you should keep in mind is that since the underlying price cannot possibly be in two places at one time, and therefore cannot breach both of your credit spreads at the same time, the vast majority of brokers out there will consider the risk and capital requirements for an iron condor the same as if you only had a one-sided credit spread on. This, of course, is provided that both the bull put spread and bear call spread have the same expiration date and same number of contracts. If one side has more contracts, brokers will generally compute the risk on the side with more contracts when determining your iron condor capital requirements. And the fourth thing you should know is that there are always ways to adjust an iron condor if one of the sides gets threatened by the underlying price. Whenever you adjust, the goal should always be to gain additional credit for doing so. But since this is a bit beyond the scope of this video, we'll address adjusting credit spreads and iron condors in another video. Okay, so the best way to describe how to trade an iron condor is probably just to look at a chart. So I'll pull up my chart of SPX, or the S&P 500 stock index, to show a potential trade. As usual, I'm using the Thinkorswim platform for the charts and to put in trades, but you could use whichever trading platform suits you best, and the results will be very similar. Okay, as we can see here, we have the SPX hourly chart. This is the S&P 500, and it's an hourly chart, which just means that each of these bars or candlesticks are worth 1 hour of price action. So if we take a look here, we could see that we have a bear call spread up here, and then a bull put spread down here. So this is basically an iron condor, as we've been talking about. So here, as we can see, we are framing price between these two call spreads, and these are both credit spreads. So to the upside, we have a call credit spread, or a bear call spread, and here the short strike is at 22.35. The current price is around 21.81 at the time I'm making this video. So once again, the call credit spread, or the bear call spread, is at 22.35. That's the short strike, and then 22.40 is the long strike. And when you put this on, you do get a credit, which I'll show in a bit. To the downside, we have the bull put spread. The short put is at 21.05, and the long put is at 2100. Okay, so this is an iron condor once again, a bear call spread to the upside and a bull put spread to the downside. And as I mentioned before, if price stays between these two call spreads during the duration of the trade, then that's when you can get maximum profit or maximum premium from that iron condor trade. Now, as I mentioned before, also the risk involved here is either between the 22.35 and the 22.40 to the upside, which is the width of the bear call spread, or the width of the bull put spread, which is between 21.05 and 2100. So either or will be the risk involved, because once again, price cannot be in both places at one time. Okay, so now that we know what an iron condor generally looks like, let's see how to actually trade one. And for that, I'm going to go ahead and open the Trade tab. So this is the Trade tab, and here we have the options chain for SPX. And here, as we can see, the expiration date that I've chosen is simply 29 days from now, around 30 days, but you could use whichever expiration date that you decide is most appropriate. Again, you could certainly feel free to place a full iron condor all at once, but we prefer to stagger the entry by placing the two credit spreads separately according to how the underlying price moves. But for the purposes of this example, I'll first show how to place a full iron condor. So first, what you would simply do is right-click on the options chain, and then go to Sell, and then go to Iron Condor. And here, as we can see, it opens up a little window here, and you could change the number of contracts, and you could also change the expiration dates, as well as the strike prices, which is very important, and of course the premium that you're shooting for right over here. And of course, the strike prices should be changed according to how you want to frame the price action in terms of placing your bear call spread and your bull put spread. And these are these two things right here. And then when you're done with the trade, you would simply click on confirm and send, and that would be your Iron Condor. Now, to place the Iron Condor the way we prefer to do it, separating the credit spreads, you would place the bear call spread when the underlying market is moving up by right-clicking on the call side of the options chain and choosing vertical, then sell for a credit spread. So as we can see here, we have our bear call spread short strike that we want right here. We simply right-click, go to sell, go to vertical, and then we have our bear call spread right here. And if the market was moving down, you would then right-click on the appropriate option on the put side of the options chain, choose vertical, and then sell for a credit spread. So as we can see right here, this is the put side of the option chain. You right-click, go to sell, go to vertical, and again, here we have the bull put spread that we could set right here when the market is going down. Now, once you do this, you would have a full Iron Condor, and preferably wider than if you had just put it on all at once. So there you go, just a quick and simple video on trading the Iron Condor options strategy, one of our favorite income strategies. Hope you found it useful. We'll have plenty more instructional videos on trading options going forward. From all of us at OptionsPath, thank you so much and have a great day.